Hello class and welcome to our sixth lecture series on Managerial Accounting, and I'm your instructor Jamal Haider. So today we are starting a new chapter which is cost volume profit relationship. But before going to its introduction, so I'm going to upload the solutions. Please see our WeChat group. I'm going to be uploading its solution. And if you have any question regarding the solution or regarding your assignment, please do ask. So I'm going to pause the video here and let's discuss the assignment. Okay, we just finished discussing our assignment. Okay, let's start our today's lecture, cost volume profit relationship. So basically this chapter is, as you can focus here on cost, volume, profit relationship. We also call this CVP analysis or CVP relationship. So up till now, what we have discussed or what we have learned throughout this, previous discussions, that what if you increase the cost, what would happen to the profit, right? So basically the focus of CVP analysis is that what if we change cost, what will happen to the profit? Or what if we change volume, what will happen to the profit? Or what we change cost and volume both and want to see the impact on profit? What would happen if all three changes? Or what if the other two changes, what happened to the sales? So you can just correlate. So you can change one variable or you can change simultaneously 2 or 3 variables and you can find out what is the simulation regarding that one, right? So the objective here to find out that best strategy which gives you highest profit, right? Let's dive into that one. So our first learning objective is explain how changes in activity affect contribution margin and net operating income. So the new term here is contribution margin. So what is contribution margin? Anyone can guess? Christine, Chandra, Sipade, David? You want to comment on that?
I know it contributes for a better change. That's for sure.
Min or Ronnie? Any
So
comment?
what was your question? What is contribution margin?
Yes. What do what first thoughts comes to your mind when you read this word, contribution margin?
Selling price per unit.
Okay. Min or Ronnie?
But you also have to minus the cost
Without
of the
the
variable.
variable cost.
You said variable cost. Arone, Min, can you hear me? Guys, can you hear me?
Repeat your question, sir?
Yes.
I went to fill up my water.
Oh, okay. So just want to ask, can you hear me, clear?
Yes.
Yes.
Okay. Min, I'm asking what, first thought comes to your mind when you read this contribution margin. Min?
I'm not sure. Is it something relate to selling price and variable cost?
Selling price, variable cost. Okay. So all of you guys are pretty much on the same page. So try to derive the definition by just looking at the word. Contribution margin. How much this contribute to the profit. That's it, right? So many of the students, they just were terrified or horrified with the, you know, these kind of big jargon stuff. Okay, what is the definition of this one? So to simplify the stuff, just pay close attention to the word, and then you can try to derive your own definition, and it will help you to grasp the concept and retain that concept for a longer period of time. So contribution, how much we are contributing to the margin. So it involves variable cost as well, sale price as well. So let's just explore this concept. Okay, so basics of cost volume profit analysis is that we will be following our RBC example, which is racing bike company. So they have presented their information here. So what they are doing, they are selling 500 bicycles. So their sale is 250,000. It means sale price is, can we calculate the sale price? 250,000 divided by 500. Answer would be 500. So it means they are selling units 500 with 500 price. So their variable cost 150,000. So you see here contribution margin here 100,000. Their fixed expense 80,000, and now their net operating income is 20,000. Right? Now let's read this definition. The contribution margin income statement is helpful to managers in judging the impact on profits of change in selling price, cost, volume. The emphasis is on cost behavior. So recall our discussion regarding when we talk about the classification of cost based on behavior. And over there we read about variable cost and fixed cost. And what did we learn about the behavior of variable cost? Variable cost in total changes with the level of output. But variable cost per unit remains the same. So what is the behavior of fixed cost? Fixed cost in total remains the same whether we increase the production, whether we decrease the production. It is irrelevant with the production. But fixed cost decreases when number of output increases. So it means we can rely fixed cost in total basis like 80,000, but we cannot rely fixed cost when it is divided by number of units. So we cannot rely fixed cost per unit because its behavior is not same. But we can rely variable cost per unit because per unit variable cost remain same. Right? That's what we learned in our classification of the cost, chapter 2, under classification by behavior. Right? So the definition would be contribution margin is the amount remaining from sales revenue after variable expense have been deducted. In simple sense, sale minus variable cost is your CM, contribution margin. Understand? Or let me give you another definition which is very meaningful. And that is the contribution margin is 100,000. What does it mean? So contribution margin shows, the other meaningful definition is after covering fixed cost, right? After covering fixed cost, whatever left after sale minus variable cost directly goes to operating income. Understand? So whatever left after sale minus variable cost is 100,000, right? This is contribution margin. And when you cover the fixed cost, 80,000, that is your profit. So if I say my CM is contribution margin is 82,000 and my fixed cost is 80,000. So can you find out, can you just looking at this figures, can you find out what is my net operating profit? Just cover the fixed cost, that's it. It means 2,000 is your net operating profit. That's it. So one thing, did you notice here, we are not talking about interest and taxation here, right? In income statement, we do have to minus taxes and interest, right? Simply, right? We have to minus it, but we are not discussing here. Why? Because those costs depends on external factors. Interest we cannot control. The interest rate is dependent on economy, state bank or central bank's decisions, macroeconomic factors, money supply, right? Global factors. Tax rate, we cannot control the tax rate. Government increases the tax rate, decreases the tax rates whatsoever. So that's why we are taking out of control. That's why we're talking about operating income, not net income. So many students are confused that after covering fixed costs, still we are not having 2,000, we are having 1,000 net profit. So sir, this is not the the true definition. No, we are talking about net operating income, which comes from business operations. So business operations, which is above, if you, let me just write it down, the traditional formula for net income that we learned in our accounting class, that is sales minus cost of goods sold. We have gross profit, and then we less selling and admin, then we have net operating income, and then we less tax and interest, right? And then we have net income, right? So we are just talking about this one, not net income. Why? Because we don't have control over taxes and interest rate, right? So in this case, we want to know that how much our business operation is giving us profit. Internal business control, that is our internal strength, internal weaknesses we can control over this. So that is in our hand. So now if we change sale price, or if we change the cost, what will happen to our profit, right? So our focus is this net operating income, not the net income, right? So throughout this chapter, we will be focusing NOI, not NI. See, net operating income, which is also called in finance books and other accounting books EBIT, which is earning before interest and taxes, right? Earning before interest and taxes. Okay, let's move. So